We just had a crazy week, so let's jump into it and see what happened. So Elon Musk just bought 9.2% stake in Twitter, and that's a massive move for the world's richest person. These account for $2.89 billion, and he's already up 1 billion because the stock skyrocketed more than 25% on the 4th of April. Who would have thought so? So now Musk's wealth looks like this. Lots of Tesla shares, lots of Tesla options, and a lot of SpaceX, and a bit of Twitter, now accounting for $3 billion. Now you may wonder, what are these Tesla options and why they represent such a big chunk on Musk's wealth. So Musk doesn't receive any base salary or cash bonus. Instead, he receives stock option based on the company hitting certain financial and market value targets. His 2018 pay package allocated 101 million split adjusted shares to be awarded to Elon in 12 equal tranches as the company hits those milestones. So these options, they have an expiry date, and at the moment they are tax-free. So he doesn't have to pay taxes on the options that he has. However, as soon as he decides to exercise these options, so effectively to buy Tesla stocks at the option buying price, he will need to pay taxes on the profit. Something like that happened last year when he had to exercise 22.9 million Tesla options that were about to expire, which in turn generated a record 11 billion tax bill. Now let's go back to Twitter. What I found most interesting here is that we know about this market move because of a filing disclosure by the US Security and Exchange Commission, commonly known as SEC, where the CEO of Tesla bought 73,486,938 shares of Twitter, dated, hear me out, the 14th of March 2022. Now, that amount of money that Elon Musk spent on that day to buy Twitter didn't affect the stock price, which didn't go up neither down, but simply continued its course. However, as soon as we got to know that Elon Musk bought that position on Twitter, the stock literally skyrocketed. And I'm sure that all this hype will fade away as the time goes on. But it's incredible, and I want to remark that as much as the market is a place full of numbers, percentage, and points, it's still a very emotional place. And I think we are seeing this now than ever before. GameStop, AMG. So soon after, he got appointed to the director boards because, come on, if you have such an investor, and in this case we talk about the biggest shareholders in Twitter, and his name is Elon Musk, you want to invite him at the big table. In addition to that, I think he has some ideas of how to run these meetings, and he published something on Twitter about it. Now let's move to the big boys. The Federal Reserve wants to slow down inflation, and to do so wants to raise interest rate and at the same time reduce its balance sheet. In the meantime, in Europe it's Black Friday. Well, not for real, or not the one that we are used to know, but still, the Stoxx 600 index versus the S&P 500 shows a very nice and juicy discount. As you can see from this graph, the evaluation is at near 16 years low against the US shares. And I'm thinking about all the investors that they just focus on the US market because of its success in the past and obviously its current size. But I think that having a global tracker is always important, especially in moments like this one. Lastly, shall we talk about the elephant in the room? The yield curve. For those who are clueless, this is the most famous recession indicator ever. And what it shows is simply the yield or interest rate on the y-axis against the various US Treasury bond maturities ranging from 3 months to 30 years. Now, as you would expect, If you buy a treasury bond with maturity date of 30 years, 3 decades, let's say, you would expect a coupon payment a bit higher than a bond with maturity date in 3 months or a year. And I'm telling you why you would expect this a slightly higher payment, because basically you're taking more risks. You see, when you take a bond for 30 years, it's very difficult to understand what the world will look like in that amount of time. So you're taking more risks by not knowing what interest rates are going to look like, or what inflation is going to look like. So to compensate or to get rewarded from that additional risk, you get a higher coupon payment. And I'm telling you why you would expect a slightly higher coupon payment or yield. Because basically you're taking more risks. So the company or the government might default on its debt. At the same time, it's difficult to forecast how inflation is going to look like in 30 years. It might be higher than expected. Like now, exactly. So an ideal curve looks like this one. A nice increasing curve. The longer the maturity date, the higher the yield of the bond. However, and there is always an however, when you start getting a yield that is higher for short-term bonds rather than for long-term ones, the curve might start flattening and it can get to the point when it reverts. And this is a strong signal, probably the most famous one, of a recession coming. Well, its success is due to the last 5 decades where it effectively forecast every single recession. So now let's have a look at this graph here from the Federal Reserve of the Bank of New York. These show the probability of the US recession predicted by the Treasury spread 12 months ahead, which means that it is forecasting for next year. And this graph is based on the steepness of the yield curve. The blue areas are the past recessions, and is extremely good at picking them, although it must be said that there are also false positives. At the moment, the probability appears to be below 10%, very small, but still, this is just one indicator. So to have a better view in general, in every sector, discipline or environment, you want to look at multiple indicators. And if they seem to agree, then you might draw your conclusions. But if you look just on one indicator, whichever it is, also the yield curve, well, you don't really stand on solid ground for your conclusions. That was all. See you next week.